Paco, you run one of the biggest trading and investment banking businesses in global Wall Street across the globe. You also run the Treasury and Security Services business at Citigroup, one of the fastest growing parts of the business. I think it's worth talking about at this point in the markets. A lot of question about the direction of travel, particularly for trading and investment banking, where there was a boom time in 2021. So what does normal look like moving forward, particularly for trading, when we see some businesses? Just a few minutes ago, we had reported that Citadel Securities faced a 35% drop in the business. What does normal look like the rest of the year?
Well, the reality is that we don't know very well. I think we have to remember that trading businesses are still good. If you compare overall industry trading revenues to what they were in 2020 or 2019, the numbers are significantly higher. So it's not bad. They look worse if you compare them to recent, so the 2022 years, but they are still very healthy. And what drove that health in trading revenues is still around. We still have uncertainty in rates. There is, uncertainty about the economic situation. There's a lot of trading and readjustment of portfolios that has to happen. So I don't think I have reasons to be very negative about what trading revenues are going to be in the coming quarters. But the truth is that I don't know.
Now, some businesses, say commodities, have faced a fall off over the last several months. However, things like rates, how much of a structural headwind or tailwind is that to the industry now that we have a new economic regime across the world?
Yeah, I think rates is a positive part of the story, because we have to remember that we've had many years with zero rates, with rates almost dead, very little uncertainty about what rates we're going to do. And we have now a comeback of the rates business with uncertainty about what they're going to do, but with a rate to play with. We didn't have a rate to play with before. So I think rates is going to continue to be, is now and continue to be a very active part of our trading markets.
What about other parts of the business, investment banking? There has been a prolonged slump. There have been headcount reductions at many Wall Street firms, including yours. At what point do you see the needle starting to turn, or do you think it could be a lot worse before things start to get really better?
I don't think it can be a lot worse, because it's limited by the need. The need is there, and the need is accumulating through months of inactivity. So at some point, even if the market situation is not great, the fact that needs have accumulated will take over and will start generating revenue. It has also been one of the longest slumps on investment banking revenues that we have experienced. It's longer than the one that followed the financial crisis. So it has to turn at some point, because the reason for those activities to be there and to happen has not gone away. We cannot say exactly when, but I think it's more likely to come back than to go in the other direction.
In anticipation of that, does that mean that workforce reductions in that space are definitively over, or can there be more pressure? Given the competition you're seeing across the industry, how are you thinking about headcount in the investment bank in particular?
Yeah, there could be more pressure, but if you look at the reductions overall in the industry, they are small compared to the slump in revenue. So people have been holding back and are trying to keep capacity for when the turn happens. I think things would get worse if that turn doesn't happen, but as I just said, I think it's more likely to happen than not.
What about trading? The interesting thing is that there have been a number of departures in trading over the last year or so when you look at Citigroup, but really there has been a lot of competition from hedge funds, private equity firms for every bank in this industry. Yeah. What does that look like? And is this a matter of competition or a matter of how you're managing the business differently?
I think it has to do with the regulatory regime, capital constraints, and what are banks good at given the regulatory regime. And I think there are things that we were doing before that just don't make sense for us to do. And there are things that continue to be profitable and things that are necessary to our clients, and we continue to do for them. We still don't know what the final regime is going to be. As you know, this week we're going to have a better sense of what the treatment of trading revenues, trading activities is going to be. But that, until we get that, we will not be able to know more definitively what should the trading business of a bank look like.
Well, let's talk about that a little more. You're talking about the Basel III endgame final proposal here that's going to come out. There will be a comment period for the banks to really push back on some parts of that. It'll be a while before it takes effect, but they are pretty drastic, these rules. How significantly can it change the businesses that you're operating in now?
It could, although I am more optimistic than that. I think these businesses have shown many times that they can adjust. And I think we will learn what the rules are, and we will adjust as well. And most likely there will be a significant business for us to do still after the rules happen. Also, the markets will adjust. There will be things that will be moving from banks to non-banks, risks that will be moving from banks to non-banks, and the system will find a new balance on this thing, with banks still playing a significant role. That's what I think will happen, but the rules themselves can have a significant impact.
What are some of the businesses more specifically that you might have to take a look at, whether it's in the mortgage area where there will be higher capital requirements or certain parts of trading? Are there areas that you can see having to take a look at if these rules were to take effect?
There are. I mean, we have to wait for the rules and see how the rules impact. There are areas in, say, for instance, exotic derivatives that may be much more costly to run from a capital standpoint. Financing may change as well. Businesses like Prime could be seen differently. The market will adjust to that as well. So we don't know what the final impact will be. But anything to do with financing, with leverage, we're going to have to see how it ends after the regulation comes out. But it's difficult to say, because it's not just what the rule says, it's what the rule says plus how the market reacts to it, plus how the banks react to it, where will define the end result.
One important part of this is the concern that is under the market that Treasury Intermediation could be significantly impacted from some of these rules. Do you think that that is an area that might face further pressure at a time where there are concerns under the surface about liquidity?
I'm not sure that the new rules are going to impact that very much. That is already impacted by the existing rules. Sometimes, depending on which constraint you're under as a bank, you may be limited in your ability to do almost riskless transactions with treasuries because of the leverage ratio or other capital constraints. That is already a factor. I'm not sure it is going to get worse with these regulations, but we will have to see.
You mentioned leverage. When you look across the system, there has been a lot of instances in which leverage has come to the surface, hidden pockets of leverage, if you will, that have led to very large financial calamities, if not systemic, certainly impacting certain markets. The LDI pension blow-up, for example, being one of them. You saw this in the banking system. To the extent that you're still concerned about leverage in the system after such a long set of prolonged low interest rates, what are you still worried about?
Well, it's true that leverage is always present when you have something going wrong, but it's not just, it's leverage plus market move. What you had in interest rates was a massive move in rates after a very, very long period of very, very low interest rates. And you would have expected that that would cause some problems. If you look at the problems, they are not that gigantic. I mean, it's not like the system came down, right? It is not. There are problems that have been relatively well digested up to this point.
But if you take a look at spreads right now and certain kind of